Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on perspective on availability of fertilizer and adequacy of subsidy budget in the short term. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Hira Nand, Director of Finance at National Fertilizers Limited. Mr. Shivakumar Subramaniam, Executive Director of Finance, Rashtriya Chemicals and Fertilizers Limited. This session will be moderated by Hardik Shah, Director at CareEdge Ratings. We will commence this session with a presentation by Richa Bagaria, Associate Director at CareEdge Ratings. This will be followed by a panel discussion and Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Richa to make the presentation.
Thank you, Mamta. Good evening, everyone. Let's commence the presentation with the key takeaways. Above normal monsoon, adequate reservoir level, and enhanced minimum support prices for Rabi crops augur well for the Indian agricultural sector and, in turn, demand for fertilizers. Expanded capacity of domestic urea production is aiding in reducing imports of urea, which constitutes majority of domestic fertilizer consumption. The rationalization of input prices after the sharp increases in FY23 has led to reduced subsidy burden. However, there are some concerns around the availability of a few complex fertilizers with the onset of the Rabi sowing season. With recent rise in diammonium phosphate DAP prices, and release of up to 56% of subsidy till September 2024, the sufficiency of the fertilizer subsidy budget for this year and working capital intensity of industry players remain crucial aspects to monitor. Before we begin the detailed discussion, I would like to take you through the topics that we intend to cover in today's presentation. In today's webinar, we shall cover dynamics of agricultural sector encompassing trend of monsoon, water storage level, and area under cultivation, which are the driving factors for demand of fertilizer. Subsequently, we shall discuss the extent of import dependency for various fertilizers, which is urea, DAP, and other nitrogen, phosphorus, and potassium NPK fertilizers. We shall also touch upon the near-term supply constraints in DAP given its high import prices. Moving ahead, we shall understand the multi-year trend of key input prices, which is ammonia, rock phosphate, phosphoric acid, and sulfur, along with trend of natural gas price. We will also cover the past year's subsidy budget as well as subsidy release in first half of last 3 years. Finally, we will discuss the key industry aggregates and the key monitorables that may play a pivotal role going ahead. Higher demand for agricultural products driven by population growth and changing dietary preferences leads to a great need for fertilizers to boost production and ensure food security. In this background, let us look at the monsoon pattern over the years and water availability in reservoir. Left chart depicts the trend of rainfall over the last decade as a percentage of long period average. Long period average is the benchmark to forecast rainfall and is based on last 20 years average, which is 1971 to 2020 period, during which India received 87 centimeter of rain recorded from June to September for the entire country on an average. Examining the graph, we observe that the years CY19 and 20 experienced above normal monsoon, while CY20 and 22 saw a normal monsoon. The year 23 was marked by the El Nino, wherein India witnessed slightly below normal monsoon at 95% of long period average rainfall. Historically, El Nino winds have been associated with reduced rainfall in India, a pattern that held true in CY23 as well. Inadequate rainfall impacted soil moisture levels and reservoir level along with sale of fertilizers. Moving to current season 2024, India witnessed 8% above normal rainfall, which augurs well for the demand of fertilizers this season. Despite of distribution issues with lower rainfall in North Punjab, that is North India, that is Punjab and Haryana, and eastern states, Bihar, Eastern UP, and Gangetic West Bengal during the sowing season, and excess rainfall in South India and central states. This was accompanied with delayed withdrawal of monsoon, which may delay the Rabi sowing by a few weeks. In a 10-year average, reservoirs are filled to around 76% of full reservoir level, as can be seen from the chart on the right. However, in 2023, due to the below normal rainfall, the reservoirs were filled to only around 70% as of November 1, 2023. Nonetheless, thanks to above normal monsoon this year, the reservoir level has risen to 87% as of November 1, 2024, which is significantly higher than the historical levels. This highlights the significant influence of rainfall patterns on reservoir levels and, by extension, on the demand for fertilizers in India. Now that we have the perspective on the rainfall and current reservoir level, let us delve into the area under cultivation and Kharif and Rabi sowing pattern. After improving over FY 2022, overall area under cultivation dropped in FY 23. Below average rainfall and reservoir levels in 2023 forced farmers to reduce the area under Kharif crops with almost stagnant Rabi crop sowing. These factors dragged down fertilizer sales volumes in FY 23 and 24. However, coming to 2024, aided by the surplus rainfall and increased reservoir level, Kharif sowing was up by 1.9% year-on-year. On the bottom right-hand side of slide, we can see continuous improvement in sowing pattern of Rabi crops with almost stagnant sowing in 2023. However, above normal monsoon and adequate reservoir levels as seen in previous slide is expected to lead to improved Rabi sowing, which however could be delayed due to delayed withdrawal of monsoon. Agriculture produce prices are continuously determined by market demand and supply conditions. When crops arrive in the market, wholesale prices typically fall, which negatively impacts farmers. To safeguard their interests, the government sets a minimum support price (MSP) to ensure that farmers can sell their produce at a price at least equal to the MSP. To ensure transparency, the government uses a formula to calculate MSP, ensuring that it is at least 50% higher than the production cost. This formula takes into account expenses such as seeds, fertilizer, pesticides, hired labor, among others. As shown in the slide, MSPs for major Kharif and Rabi crops have consistently increased. In October 2024, the government announced revised MSPs for the upcoming Rabi season, with prices for major crops rising in the range of 2% to 7% to align with increased production costs. Change in the MSP for wheat and barley were in the range of 6.59% and 7.03% respectively. The timely increase in MSPs has contributed to higher food grain production in recent years. The recent rise in MSPs is expected to continue driving agricultural growth, which in turn will support increased demand for fertilizer. After discussion on the prospects of agriculture and its consequent impact on demand for fertilizers, we shall now be moving to the fertilizer sector updates. Here on the left side of the slide, we can see the consumption pattern of fertilizer for urea, DAP, NPK, SSP, and muriate of potash, MOP. Fertilizer consumption grew by 6% and 8% during FY20 and FY21 respectively, post which it witnessed a sharp degrowth in FY22. Consumption improved in FY23, which was again hampered by lower monsoon and reservoir level in FY24. Going ahead, we expect the overall fertilizer demand to grow at about 2% to 3% in FY25, driven by factors discussed in the earlier slides. India continues to be dependent on imports of fertilizers and its key inputs. Import dependency has gradually reduced from 31% in FY21 to 27% in FY24. India imports 20% of its urea requirement, 50 to 60% of its DAP demand, and entire MOP needs. Further, as can be seen from the pie chart, urea continues to have the major share in the overall fertilizer consumption, thanks to the regulated pricing through subsidies given by the government. DAP and other NPK are other major fertilizers used in India. Let us now dive deeper into the dynamics of individual fertilizers and begin with urea production and import trend, where the industry has added significant capacity in the last few fiscals, leading to reduced import dependency. Historically, India has been dependent on urea import to the extent of 25% to 28%, To boost domestic production, the government notified the new investment policy 2012 in fiscal 2013. Under this, 6 plants with a capacity of 12.7 lakh metric tons each have been gradually commissioned over the past 5 fiscals. As a result, the total installed capacity of urea in India increased by over 30% to the present capacity of 313 lakh metric tons per annum, with majority of the urea capacities operating at optimum capacity utilization level. The capacities added in recent past and expected in FY26 are shown in the table on the bottom right side. Dependence on imports of urea has seen a decline from 27% earlier to 19-20% in recent years, with stabilization of added capacities in the domestic market over FY22 to FY24, leading to higher domestic production. With proposed commissioning of 12.7 lakh metric tons per annum capacity at Talcher, the import dependency is expected to further reduce to less than 15% by FY26. Adoption of nano-fertilizer where government has major thrust can further reduce import. Hence, we can safely conclude that India is inching towards self-sufficiency in urea production. Now, we move to DAP, which is the second highest used fertilizer in India after urea, where India continues to have high import dependency over the years. Close to half of the requirement of DAP is imported. DAP contains 46% phosphate and 18% nitrogen. During H1 FY25, the production of DAP and especially its imports has reduced when compared on YOY basis, as can be seen from table on the right. With onset of Rabi season, the assessed requirement of DAP for Rabi season is estimated at 55 lakh metric ton, while the carry forward stock as on October 1, 2024 was around 47% lower than a year ago. Currently, the international price of DAP has increased to around $650 per metric ton, that is at around rupees 55,000 per metric ton, which stood at $515 per metric ton in May 2024. On the other hand, MRP has been fixed at rupees 27,000 per metric ton and subsidy available is rupees 21,911 per metric ton, resulting in imports being economically unviable. The government has approved one-time special package on DAP beyond the NBS rates on actual point of sale of DAP for the period from 1st April 2024 till 31st December 2024 at around rupees 3,500 per metric ton to ensure sustainable availability of DAP at affordable prices to the farmers. Nonetheless, the contribution margin continued to remain negative. Thus, DAP's availability or government intervention for making DAP available in required quantities shall remain key monitorable, especially in light of its increased prices. Here we can see that fertilizer prices were extremely high in FY22 and 23. This sharp increase in fertilizer prices was attributed to rise in raw material and gas prices on the back of war between Russia and Ukraine, short supply of few key raw materials due to sanctions on Russia and Belarus, rise in freight rates, rise in coal prices, COVID-related supply chain disruptions, China suspending export of few fertilizers, and across the board rise in commodity prices globally. Prices started cooling down in FY24, where it remained largely stable. DAP prices has again witnessed a recent surge due to the supply side concerns. Let us now take a look at the multi-year trend of key raw material prices, which drives the prices of the fertilizers and in turn the subsidy budget. As we can see, prices of all the key raw materials remain elevated in later part of FY22 and most part of FY23. Ammonia prices show a record high due to surge in natural gas prices globally, especially after Feb 21. Also, there was an increasing trend in prices of rock phosphate, phosphoric acid, and sulfur due to increased demand with supply constraints due to various reasons which we discussed a short while back. Prices of almost all the raw materials has rationalized post FY23, paving the way to ease fertilizer price and subsidy burden. However, the price of ammonia has started increasing since June 2024. Natural gas forms majority of raw material cost for urea production and is an important input for other fertilizers as well. Out of total domestic gas production, more than 50% is consumed by fertilizer sector, followed by other sectors. So here we have given a trend of prices of domestic gas allocation from both normal and difficult fields. The formula-driven prices for domestic gas has also got rationalized with softening of imported gas prices, wherein price of normal field is currently capped at USD 6.5 per MMBTU, whereas price of difficult field is at USD 10 per MMBTU, when compared to imported gas prices, which is hovering at around USD 12 to 13 per MMBTU. The rationalized prices of domestic gas as well as imported gas is helping the sector for lower cost of production and in turn lower subsidy requirement. We shall now shift our focus to the other important aspect of the sector, which is fertilizer subsidy. The total subsidy allocation under fertilizer sector is divided into urea subsidy and nutrient-based subsidy, NBS. Under NBS, the subsidy given to the companies for complex fertilizers is fixed annually on the basis of its nutrients content, which is nitrogen, phosphate, potash, and sulfur, on per kg basis, which is converted into subsidy per ton depending upon the nutrient content in each of the fertilizers. These rates are determined taking into account various factors like the international and domestic prices of P&K fertilizers, exchange rate, inventory level in the country. Here we can see upward revision in the nutrient-based subsidy in FY22 and FY23 to ensure availability of fertilizers in the country. However, for nitrogen, subsidy has been enhanced sharply from Rs 18.8 per kg till FY22 to Rs 95 per kg in FY23, mainly because of sharp increase in natural gas prices. Increase in subsidy for nitrogen was much sharper than other nutrients as there was no change in subsidy component for nitrogen over the past few years, whereas subsidy for phosphorus was enhanced in two-step process during FY22 and then in FY23. Increase in nutrient-based subsidy rates were largely in line with rise in input costs of these nutrients. With moderation in raw material prices, Government of India has substantially reduced the subsidy rates under nutrient-based subsidy during FY24. The downward revision of rates continued in FY25 for nitrogen, whereas subsidy for phosphorus was increased to have a balanced application of urea and complex fertilizers so that quality of soil is maintained. This moderation has allowed the government to reduce the financial burden while ensuring the availability of fertilizers in the country. There are a few interesting takeaways from this slide. Historically, subsidy budget used to be in the range of Rs 70,000 crore to Rs 80,000 crore per annum during FY17 to 20. The total subsidy outlay increased by 58% during FY21 to Rs 1.28 lakh crore, mainly due to additional allocation under Atmanirbhar package of Rs 62,000 crore targeted towards clearing previous subsidy backlogs which had been created due to NBS1. Subsidy payout increased from further to Rs 1.54 lakh crore in FY22 with increase in gas prices leading to higher subsidy for urea, whereas increase in raw material prices led to high subsidy for NPK during the year. In FY23, the fertilizer subsidy reached an all-time high of Rs 2.55 lakh crore due to sharp rise in almost all the input prices. With easing of input costs, including gas prices, subsidy was reduced to Rs 1.95 lakh crore in FY24 and further to Rs 1.64 lakh crore in FY25. Given that 56% of subsidy has already been released till September 2024 and input price of ammonia and import price of DAP are on a rising trend, the adequacy of subsidy in the second half of FY25 would remain a key monitoring. Here we have studied the last 5 years financials of sample of 13 leading fertilizer companies in India, which comprises of over 70% of total urea capacity and 50% of NPK capacity. If we see the graph on left side of the slide, we can see that leverage of fertilizer companies was high in FY20 and interest coverage was low in FY20. This was mainly because with the adoption of DBT1, subsidy payout to fertilizer companies was delayed. Also, on the back of inadequate subsidy budgets till FY20, there was large subsidy backlog with fertilizer companies, which was funded by working capital borrowings, leading to high leverage and lower interest coverage. However, with the additional subsidy allocation in FY21 under Atmanirbhar package, large subsidy backlogs were cleared in FY21, which led to improvement in leverage and interest coverage in FY21. With adequate subsidy budget and timely release over the years, debt levels remained on the lower side. The graph on the top right side depicts the reduction in receivables, including subsidy, in FY21, mainly upon clearance of large subsidy backlogs. After witnessing slight increase as on March 31st, 2022 and March 31st, 2023, it reduced as on March 31st, 2024 and further stood at comfortable level as on September 30, 2024. The graph on the bottom right side of the slide shows the short-term debt as a percentage of total debt for these fertilizer companies, depicting a similar trend. Accordingly, financial health of fertilizer companies has significantly improved in last 2 years, and they are well positioned to handle any potential subsidy backlog during FY25. These are some of the key monitorables which would drive the fortunes of the sector going forward. First is the movement in the prices of natural gas, wherein the industry is dependent on imports and price of raw materials as of now is largely stable except for an increasing trend in ammonia prices. With onset of Rabi season, the availability of DAP remains a concern, given low imports leading to reduced inventory level. Given that 56% of subsidy has already been released till September 2024 and input price of ammonia and import price of DAP are on a rising trend, the adequacy of subsidy and working capital position in the second half of FY25 would remain a key monitorable. Proposed implementation of DBT2 would be revolutionary and fertilizer companies would be clear beneficiary from it as they will no longer be dependent on the subsidy payout by government. Adoption of environment-friendly and more efficient nano-fertilizer would lead to improved crop and conserve environment, apart from further reducing import dependency. Accordingly, its higher penetration would be critical going forward. With this, I conclude my presentation. Thank you. Over to you, Mamta.
Thank you, Richa. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Hardik Shah to take over the session, please? Hardik Shah is a qualified chartered accountant and a CFA and has over 19 years of industry experience with a focus on corporate credit ratings. At CareEdge Ratings, he has led various rating teams across diverse sectors. Over to you, Hardik.
Thank you, Mamta, for the quick introduction, and big thanks to Richa to bring out an insightful presentation. Good evening and very warm welcome to everyone who has joined us today for this webinar. Indeed, it gives me an immense pleasure to welcome our esteemed guest speakers for today. So let me introduce our speakers in an alphabetical order. Our first guest speaker for today is Mr. Hira. Mr. Nand is the Director of Finance of National Fertilizers Limited and a non-executive director of Ramagundam Fertilizer and Chemicals Limited. He also briefly served as chairman of Ramagundam. A cost and management accountant by profession and law graduate, Mr. Nand has a vast experience of more than 30 years in the field of finance, accounts, fertilizer pricing related regulatory matters, etc. He has worked with Opal, Kripco and Reliance Group prior to NFL. A very warm welcome to you, Mr. Nand.
Thank you.
Our second guest speaker for today is Mr. Shivakumar Subramaniam. Mr. Subramaniam is associated with Rashtriya Chemicals and Fertilizers Limited as an Executive Director Finance. He carries a rich experience in treasury, taxation, corporate accounts, consolidation, corporate financial strategy, fertilizer policy, subsidy and ministry coordination. Mr. Subramaniam is a Bachelor of Commerce, MBA in Finance and SEB Certified Co-Consultant. Prior to joining RCF, he was associated with Arvind Mafatlal Group of Companies. A very warm welcome to you, Mr. Subramaniam. My sincere thanks to our guest speakers for joining this session. It's time to quickly set the context before we begin the discussion with the elite panel today. So we saw in the presentation that since COVID pandemic, there is an increased focus of the government of India towards the fertilizer sector, which is absolutely visible from the adequate subsidy budgets for almost last consecutive 4 years ended financial year 24, leading to largely no subsidy buildup in the fertilizer companies. For current year also, there are a lot of positives for the sector in terms of normal monsoon leading to adequate reservoir level. MSPs are already revised upward. Input costs have been rationalized. And also now Sabi sowing is expected to progress well, and many more other factors. However, we hear some challenges in terms of availability of DAP. And on the back of increase in price of DAP and some raw materials, which is essentially ammonia, there are some concerns around sufficiency of subsidy budget for this year. So with this context, my first question is to you, Mr. Nand, that we saw there was some decline in fertilizer consumption last year, which is the financial year 23, essentially on the back of El Nino impact. However, on the back of good monsoon this year and other positive factors which we saw in the presentation for the sector, how do you see the fertilizer demand growth for the current financial year, which is the financial year 24-25? Over to you.
We understand the fertilizer demand growth will be good 2 to 4% during current year. And because of good monsoon, and at the same time, companies are getting good subsidy. So we are hopeful the momentum shall continue. And government is extending subsidy related issues are no more. They are behind us now. Government also want fertilizer should be made available to fertilizer, and industry is with government so that fertilizer is available. Ultimately, it's lead to food security. So absolutely, industry is ready, and you can see from the chart as far as urea is concerned, indigenous capacity, other plants are running at beyond 100% capacity. So we are producing about 110% if you look at on overall basis. So, and we see the growth momentum shall continue. Of course, it's a seasonal business. So cyclical inventory holding and all those things has to continue because it's an industry phenomenon.
Right. Right. So in sum up, you expect 2 to 4% demand growth this year over last year, essentially because of a lot of other positive factors which we saw. And Kharif is already over, and Rabi we have a fair visibility now.
Yes, correct.
Right. So my next question is to Mr. Subramaniam. We saw significant uptick in the input costs during financial year 22 and 23, which however got rationalized in 24, and now it has more or less remained range bound. But going forward, what is your view on key input and gas prices in the near term? Because it has a major bearing on the sector. Over to you.
Let me talk about first gas. Over the year, gas prices have been fairly stable. Only we witnessed some small spurt in crude prices, but we expect it to be largely stable in the near future. Only thing is, it is again subject to too many geopolitical happenings and certain things which are highly unpredictable. But considering that still normalcy would continue, then we expect gas prices to remain range bound, not witness a huge spike what we saw in 22-23. Similarly, with respect to input prices, I believe that input prices have peaked up. Again, it has peaked up. Like in your presentation, it was very clearly brought out that DAP prices, which were around 515, 520, has gone up to around 630, 640. I believe that has got peaked up, but there is only one cause of concern. China is one large player in the DAP and PK segment, and their absence is being felt substantially. But we expect that with some stability coming in, this will bring in substantial balance across. This is what we expect. So my take is going forward, we should expect some degree of normalcy. It may not crash, but there will be some degree of normalcy. This is what is my take on it.
I understood. It's very soothing to hear that normalcy is expected. Right. My next question is to Mr. Nand. we saw in the presentation, historically, we had very high dependence on imports, especially for urea, which is the highest consumed fertilizer in the country. Country as a whole, we decided to reduce that dependence, and over last 3-4 years, sizable capacity has come up, and consequently, our imports has also gone down significantly. Also, additional capacity from Talcher is also expected to come on stream, say FY26 or 27. So how do you see this shift? How are we placed in terms of our ability to negotiate with the exporting countries? Has that been different now vis-a-vis, say, 4 years back? Or how the import dependency could be there going forward?
See, I see from two different perspectives. Still, we are importing about 6 to 7 million tons. Last year, we imported. Despite these 5 new generation plants have come up. Additional, some of the capacities are yet to come from these 5 plants because these are not fully 100% providing 100% of production. Two plants are there at least. So additional, some more urea would be coming from these plants. Now, about this 7 million ton, you can see the impact on international prices. It has come down drastically. Now, international prices are hovering around about $340-$350, which is much lower than what if you compare it from earlier years. And you can see the way urea prices internationally are behaving as compared to other products like DAP and NPKs, P&K fertilizers. So naturally, impact is there because we have lower offtake as a country. Secondly, this import shall continue. This is my viewpoint, because this additional capacity is giving you has to take care of incremental demand. That is also there. After these 5 plants, no any plant is envisaged as of now. Some capacities may come down the time, maybe 5, 7, 8 years, and so forth. The only further capacity or production capacity may come from these 5 new generation plants, which are producing about 1.3 million ton each. Probably their capacity utilization is limited to 1.3 million. Now, most of the fertilizer plant, if we look in history, all the plants have capacity utilization up to 115-120% capacity. But for these particular new plants, this additional capacity, how it can be increased and how prices will be fixed for additional capacity, it has not come up as a policy matter. So this, if we take additional production from these 5 new generation plants, it will I think it can add another 1 or 1.5 million ton in near time to come.
Right.
Dependency will remain there. Of course, will not be that much dependent the way it was in past.
So definitely the dependency has come down, while dependency will continue. But in terms of bargaining power, we are now more of a chooser compared to say 5 years back when we had to import anyhow. So there the bargaining power of the exporters have been much better. So as you already highlighted, there is an impact which is already visible in terms of urea prices. So definitely a bright spot for the sector. My next question is for you, Mr. Subramaniam. We saw the trend of fertilizer subsidy budget over the years, how it has moved. For the current fiscal, we have an initial budget of 1,64,000 crore, which initially appeared to be sufficient. But would like to understand your views, especially in the backdrop of rise in the input prices, rise in the imported DAP prices. Do you really see this would be sufficient enough for the current fiscal, or we may see some challenges in the last quarter of the fiscal?
Typically, as you said, we have witnessed an increased price trend, and seeing the utilization of budget up to September, it is 56%. But it is not highly alarming, because there was a time when nearly about 75 to 80% of the budget used to get exhausted by September itself. So one good thing is the estimates are far liberal, and if at all there may be a strain on account of input prices and price of raw materials spiking up, it will not be substantial. In fact, there are a lot of reports also floating that it may they whatever out be the increase, it may be between 8 to 10%, because that is what is the spike what we have seen over the period. And if at all it really comes, it may be only on account of increased volumes. But volumes are also more or less y on y, it's fairly range bound, nothing huge or something alarming what we have been witnessing in the scenario. So what I believe is a small increase would be there, and it would be easy for government also to absorb that and take it logically forward.
Right, right. So because in past also we have seen government multiple time going back to the cabinet and revising the budget. I think twice in a year also they have gone and revised the budget. So that willingness is always visible over last 5 years. So that way, as you said, the quantum may not be significant, and in that backdrop also because this year they haven't gone back to the cabinet. So that option is also always available. So that way it should not be a major cause of concern for the sector. So my next question is for you, Mr. Nand. We have set an ambitious target of green hydrogen, and some time back we did a webinar on this also, wherein one thing was clearly coming out was that essentially refineries and the fertilizers, these are the two fast mover sector in terms of consumption of green hydrogen. So in that backdrop, while old urea plants may have its own challenges in terms of migration from natural gas to green hydrogen route for ammonia production, are these new plants which have come up in say last 3 years capable of this technological migration, easy migration from say natural gas to green hydrogen route of ammonia production? And second aspect is what are the potential challenges you perceive for green ammonia production going forward, apart from the cost dynamics, given the fact that the cost parity, if we achieve, still what are the challenges you foresee?
So basically, as far as urea industry is concerned, see in the country, whatever ammonia we produce, 92% of ammonia is produced used for production of urea. Remaining 8%, hardly it goes for P&K products and some of for ammonium nitrate. So today we are in India, including new plants, are using Bosch technology. Only change is this capacities and modernization of plants. Technology is same, whether 50-year-old plant or new generation 5 plants which have come up. So these plants continue to run on ammonia producing gray ammonia only. It's a very difficult to go for green ammonia for these plants. And there are many technical challenges also into green ammonia because of lean gas. CO2 is not available. CDR plants have to be established. Then green ammonia, for green ammonia, basically so many hydrogen and so many volumetric issues are there. So it's a technology completely different from what technology today we have. I understand basically for green ammonia, if somebody is expecting we'll be producing urea, we have to go in for a complete new plants. These plants definitely, a major portion has to be refurbished. So for usage of green ammonia, what can be done is it is to be used for P&K fertilizers first. Because P&K fertilizers are using ammonia. So that ammonia, instead of gray ammonia, green ammonia can be used. Last year, we have imported about 2 million ton of ammonia, largely used for P&K fertilizers. That can be substituted. But urea basically existing urea capacity has to go with gray ammonia only, irrespective of cost-related issues. Now, if you go for P&K fertilizers, green ammonia, naturally cost is a bigger factor. And P&K fertilizer, about 60 to 70% cost is of phosphate only, potassic cost. And this green ammonia, it will multiply the cost for P&K fertilizers also. Now subsidy and all those things are going on. So as far as fertilizer industry is concerned, this green ammonia concept can be used to start with P&K fertilizers only. For urea, it is a long way to go probably.
Understood. So while using it from P&K, probably that imports can also be reduced to that extent in terms of ammonia, and it could be a initial mover, and then probably new urea plants, as you said, which can be absolutely on a different technology that can probably go with that green ammonia production.
Right.
My next question is for you, Mr. Subramaniam, and which is very pertinent in today's time. We see fertilizer sector in terms of domestic gas allocation, almost 50% is to the fertilizer sector, and it has a first priority, followed by CGD and other sectors. Recently, in current financial year, we saw a significant reduction in terms of allocation of the domestic gas, which is under administered price mechanism for the city gas distribution sectors, and essentially the CNG part. PNG is still continuing. Do you see any such chances of reduction of the domestic gas for the fertilizer sector? Because then it's a big point, because we have a key consumption here, and the import prices vis-a-vis the domestic prices, there is still a reasonable gap. What's your take? Ultimately, it's a government decision how to allocate and what much to allocate. But can you assimilate some thoughts around this? Can these things also happen to a fertilizer sector?
Yeah, as you rightly pointed out, this itself was a surprising news that allocations of APM gas got curtailed not once but twice to the CGD sector. Unfortunately, this is the situation what India is experiencing on that APM gas front. This is because basically these are all very old oil wells, and maybe if they are reaching their end of their life or something of that sort. And one thing, if you can make out, when the gas pooling mechanism came out in the year 2015, the domestic gas share was around 75% and LNG was 25%. And now the whole dynamics has changed. Now the LNG is around 80% and the domestic is around 20%. And with gas being largely being consumed for urea, and with this APM gas being exclusively prioritized for urea sector, no doubt the cut may impact some companies on the cash flow front, but ultimately who have been allotted a conventional APM gas, which there are very few companies now who are on those line and getting that gas, their contribution to pool will come down. That's what is my belief, because as long as urea is continued under the gas pooling policy mechanism, the advantage of APM was being adjusted by the gas pooling mechanism. So per se, the cost dynamics and all those things of a urea player who is not expected to undergo a change is what is my thing. But we can certainly expect this threat, because if this is the order of the day, any structural adjustment which government intends to carry may have to happen. That's it.
So can I put it slightly different? So in terms of fertilizer, if let's say allocation cut is there, then ultimately it's the government only to bear the subsidy burden. So it's the one pocket of the government to the other pocket of the same government. While in case of CNG, it is the consumers who are now suffering. While in case of fertilizer, it may not be a real incentive for the government to reduce the allocation, but in that case, the budget, subsidy budget will go up. So then there is no real reason to cut that share, isn't it?
Yeah, subsidy budget may go up because ultimately it's a pass through, and there would be an over dependence on LNG, and again that will impact the pool price. That's the way it will hit the government. That's it.
Thanks. My next question is for you, Mr. Nand. Earlier, each urea manufacturer had their own brands. Everybody had been selling under their own brand, but then the government decided for a unified urea branding across the country. So, in this process of unified branding, my two doubts in this is, During this process of migration from an individual brand to a unified branding, what all challenges you see? And second is, once these are settled, what are the positives or still some challenges you see nowadays with a unified branding?
So initially, you are right. There have been many challenges initially at initial stage, but government had considered this industry because it's a voluminous industry. So much of the big volume of fertilizer we produce, packing material is already available with the company as buffer for 2, 3, 4 months. Then requirement of different designs and colors and everything. So government taking cognizance of these limitations, recognize these issues, and given industry sufficient time to go for unified branding. So difficulties are over. Now we are with single brand. As far as fertilizer is concerned, there are no issues. It's otherwise also hot cake, except for some of the off-season months, 3, 4 months roughly. So unified branding is there, no issue. Now, fertilizer companies are dealing with other various agri inputs. So largely in India, fertilizer industry is very old. Companies are old. They have already established their brands independent of this fertilizer. So basically, like if we take the case of NFL, we used to have a Kisan brand. So we used to sell all agri inputs under Kisan brand. So Kisan brand is well established. Same must be for every other company as well. So unified branding doesn't make much of the difference as far as business as usual for the company is concerned. I don't think it has made any impact onto the way we do the business.
It's only the urea branding has changed. Rest of the products, everybody is selling under their own brand, and
no, basically all subsidized products are under unified brand. All fertilizer products, including DAP and all this.
Understood. My next question is for Subramaniam. Before we move on to the questions from the audience, we saw in the presentation that there is a significant reduction in DAP imports in the first half of the current fiscal year. And accordingly, there is a lower inventory as of October 24. And now Rabi sowing is expected to start, and it has started in some part of the country. There are concerns around availability of DAP from a few corners. So according to you, what is this whole issue related to DAP, and are there really challenges in terms of availability itself as we speak?
If you ask me, it is not question of availability. It's basically the Y on Y numbers. If you see last year, there was adequate channel inventory available, and it looked as though the supply chain was adequately would be met. It is only a threat, or this is, you can, as you can say, there is a challenge, because when you compare with the previous year and the robust demand, this year the monsoon has been good. There is enough soil moisture. There is good offtake happening during Rabi. So this is a big expectation by the farming community or by the states. Nevertheless, DOF is seized of this matter. In fact, there is a every day or practically periodically DOF is monitoring this situation on a war footing basis. This year, only thing it got pronounced on account of two reasons. One is the lack of availability from China. Okay, because the non export, there were non exports from China related contributed to increase in prices because demand was high and suppliers were short. And second was the Israel and the Lebanon crisis, because it required many ships to be rerouted and all those things. But certain issues have been resolved, and we believe that materials would be made available, and there would not be as such as the fear what is being forecasted or being expressed. That's my take on it.
Understood. So as we initially discussed in case of urea, now we have attained a good amount of self-sufficiency, which is not there in case of DAP, and because of the higher dependence on the inputs and all. So in those scenarios, in case of external disturbances, we are prone to this kind of issues time and again. So understood. Now I'm sure the audience has been anxiously waiting with some questions. So let me start taking some of the questions from the audience. One question is, how are fertilizer companies placed in terms of compliance with the enhanced energy norms, and especially energy norms are up for renewal in March 25. So how are fertilizer companies placed? Mr. Nand, if you can take this.
So basically, if you look at at a larger perspective, the energy consumption of Indian industry, particularly urea industry, is at the best globally. So basically, we are already at rock bottom. Group 1 plant is having 5.5, Group 2 6.2, Group 3 plant 6.5, and these energy levels have come from double digit. These energy level used to be somewhat around 9.5 or 10 gcal. Now for those old plants, we have come down to 6.5. For new generation plant, it is already 5.5. So there is no further scope. We don't foresee any further reduction in energy norms henceforth. Because you have to consume some energy, and there has to be certain bottom line,
Right.
and it has already achieved. So there is no further scope. There may be little bit, of course, but you need to put lot many investment for a very few little numbers, basically.
Understood.
And it has to be ultimately benchmarked from global best.
And ultimately, it should, on a cost-benefit analysis basis, it should make sense of tightening the norms. So, as you correctly said, it has already been tightened a lot, and there is a very little scope to go beyond. And especially, a lot of fertilizer companies already invested a lot in meeting the energy efficiency norms. So, by virtue of that, also most of the companies are aligned with the norms because it has ultimate direct impact on the bottom line.
Yes.
So for paucity of time, this is the last question which we'll be taking. Mr. Subramaniam, you can take this. It's quite some time that we have been hearing about DBT2 rollout. It's a first thing in the wish list of the fertilizer companies, if I put it, in terms of direct transfer of the subsidy to the farmer's account and the fertilizer companies moving out of this entire challenges of subsidy. So according to you, what is holding this back, and what could be the challenges when exactly it is actually rolled out?
Two is basically the sheer size of the farming community in India, which has been a big challenge from the government side to roll it out on this large scale. In fact, suppose somewhere about 5 to 7 years back, I was talking to some guy from the Malaysian Agricultural Ministry, and they said we have rolled out DBT, and there we are very comfortable with DBT. So I just asked, what is the size of your farmer community? So he said it was 30 lakhs. So you can just imagine where is our number. We are around 14 crores. But one good thing is, it nevertheless, we have invested in technology, we have invested in data. Now like, there is a lot of data available. 6 to 7 year data is available from 2017 to 2024. This is the right time where government can really think of how to do on a calibrated manner and how to take it forward. But coming to the actual rollout, there are two challenges. One is the there will be huge pinch on the pocket of the farmer. Well, let me take the case of urea. You see, urea, the price the farmer pays is around 5,000 rupees per ton, and the average cost is around 35,000 rupees per ton. And when you ask him to pay 10 times more, yeah, 8 times more, it will be a big challenge, and it will be how to manage that. And second, when we talk from an industry perspective, today people are taking financing risk on the corporate or on the fertilizer manufacturing companies or the trading entities. Their risk is being taken by the lenders on the corporates or these company entities. If it shifts down the supply chain, that will also be a challenge. So ultimately, anybody who wants to roll it out, because there is a criticism that whether the subsidy is targeted, everybody gets material at a subsidized prices, that is also slightly absurd. If I have the affordability, if I have the ability to pay, then why I should be subsidized? So this is also a question which is before the policy makers. So they have to certainly do a balancing act. There are philosophies, there are schools of thought which is coming in, how that you roll out where the subsidies are fairly rationalized. It's not cost plus like urea. We can try to do it in the NPK space, but all these things are a big challenge, and we need to do it. And second, when we ask me from a implementation perspective, whenever you do out a social benefit scheme, there would be some degree of criticism. This would happen. मुझे नहीं मिला, इसको मिला नहीं, मेरे को नहीं मिला. All those issues will come because the data is huge. But somewhere we need to move forward, because if ultimately the objective of government that it has to reach the poorest of the poor or the real beneficiary, this is a noble step, and this is the need of the hour. Only how we need to have, how to do this balanced act, how to manage this interim period of who will face the working capital stress and so on, solutions needs to emerge. Maybe I believe some banks may come with some ideas or some solutions, because ultimately it is their money or it is the public money which is being rotated for entire commerce. So some solutions would emerge. This is what I believe. That's my take on that.
Really wonderful views. You bring out very pertinent issues in rolling out DBT to in terms of funding the working capital requirement, and who will take that exposure to the bottom of the pyramid, people who do not have a credit history. So microfinance is one thing, but there the interest rates are too high for this kind of people to bear. So yeah, definitely. Yeah. But in terms of groundwork, what we see, most of these people are now on the banking lines. So in terms of their access to the banks, it's pretty much there in terms of the Jan Dhan account and all those other subsidy schemes. So there is a lot of groundwork which we saw in the last 3-4 years, by virtue of which we thought probably it may be a right time, once the issues which you highlighted, once those are addressed, then probably it can be rolled out, and probably fertilizer companies will be the clear beneficiary out of this. You'll not have any subsidy thing on your books. So wonderful. So thank you again to our guest speakers for their insightful views, and it was a privilege to host you both. I'll now hand over to Mamta to give her concluding remarks. Over to you, Mamta.
Thank you, Hardik, for moderating the session, and Richa for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.